Bank of America's stock is up, way up, 11% since the year began. A head-scratcher? Not really. The financial world, as always, is a game of snakes and ladders. And right now, Bank of America is slithering up a big one. But how high can it climb? And what does this surge mean for the average investor glued to their Bloomberg terminal, or more likely, their iPhone? Buckle up because we're diving headfirst into the eye of the financial storm. First things first, let's talk about the elephant in the room. Interest rates. They're higher than a giraffe on stilts. And that, my friends, is music to the ears of banks like Bank of America. Higher rates mean bigger profits on loans. It's basic economics, but sometimes the simplest answer is the right one. Of course, it's not all sunshine and roses. Inflation is still lurking in the shadows, a hungry beast waiting to devour our purchasing power. But for now, let's focus on the positive. Bank of America is riding this wave of rising rates like a surfer at Mavericks. Their loan book is overflowing and their profits are soaring. But is this sustainable? Can this momentum last? The questions that keep investors up at night, staring at their ceilings, wondering if they should buy more stock, sell everything, or just crawl under the covers and wait for the apocalypse. The truth is, no one has a crystal ball. Predicting the stock market is like trying to herd cats. It's chaotic, unpredictable, and often ends in frustration. But that doesn't mean we can't make educated guesses. So let's put on our thinking caps and analyze the factors at play, separating the signal from the noise, the substance from the hype. After all, knowledge is power, especially in the cutthroat world of finance. And in this market, you need all the power you can get. We've established that Bank of America is on a roll, but what's fueling this impressive run? Is it just the interest rate magic we discussed, or are there other forces at play? Well, as with most things in life, it's a bit of both. Yes, higher interest rates are pumping up Bank of America's profits, but there's more to this story than meets the eye. Remember the dark days of the pandemic when businesses shuttered, unemployment soared, and everyone thought the world was ending? Banks like Bank of America were bracing for a tsunami of loan defaults. But guess what? It never happened. Turns out, those government stimulus checks and loan forbearance programs actually worked. People kept paying their mortgages, their credit card bills, and their small business loans. This unexpected resilience surprised everyone, including Bank of America. They had set aside billions of dollars in reserves for loan losses, but those losses never materialized. So what did they do? They released those reserves, which flowed straight back to the bottom line, boosting their profits even further. It was like finding a $20 bill in your old jeans, a welcome surprise that put an extra pep in their step. But that's not all. Bank of America has also been busy streamlining its operations, cutting costs, and embracing technology. They're investing heavily in their digital platforms, making it easier for customers to bank online and through their mobile app. This focus on efficiency and innovation is paying off, attracting new customers and pleasing existing ones. It's a classic case of adapting to the times, and Bank of America seems to be doing it rather well. In essence, Bank of America's stock surge is a perfect storm of positive factors. Rising interest rates, a surprisingly resilient economy, and a commitment to efficiency and innovation. It's a potent cocktail for success. But as with any good party, the question remains, how long can it last? We've talked about interest rates, but let's delve a little deeper into this love affair between higher rates and bank profits. Think of it like this. Banks are in the business of lending money. They take your deposits, pay you a measly interest rate, and then lend that money out to other people and businesses at a much higher rate. The difference between those two rates, that's their profit margin. Now, when interest rates rise, so do those lending rates. Banks can charge more for mortgages, car loans, business loans, you name it. And since the interest they pay on deposits doesn't increase at the same pace, their profit margin widens. It's like selling ice cream on a scorching summer day. Demand is high and you can charge a premium. Of course, this isn't a one-way street. Higher interest rates also mean that borrowers have to pay more for their loans. This can put a strain on consumers and businesses, potentially leading to slower economic growth. It's a delicate balancing act, and the Federal Reserve, the maestro of monetary policy, is trying to walk this tightrope with the grace of a seasoned acrobat. The Fed's goal is to raise interest rates just enough to tame inflation without sending the economy into a tailspin. It's a tricky maneuver, fraught with risk. Raise rates too quickly, and you risk choking off economic growth. Raise them too slowly, and inflation could spiral out of control. It's enough to give even the most seasoned economist a migraine. The Federal Reserve, America's central bank, plays a pivotal role in this financial drama. Their decisions on interest rates ripple through the economy, impacting everything from mortgage rates to stock prices. It's a weighty responsibility, and one they don't take lightly. In recent months, the Fed has been laser-focused on combating inflation, which has been running hotter than a jalapeno eating contest. Their weapon of choice? You guessed it. Interest rate hikes. By raising the cost of borrowing, they aim to cool down the economy, reducing demand and hopefully bringing inflation back under control. But this aggressive approach comes with risks. Higher interest rates can slow economic growth, potentially pushing the country into a recession. It's a delicate balancing act, and the Fed is walking a tightrope between taming inflation and avoiding a recession. Think of it as economic diffusing a bomb. One wrong move, and the whole thing could explode. Adding to the complexity, the Fed's actions don't happen in a vacuum. Global events like the war in Ukraine and supply chain disruptions can also impact inflation and economic growth. It's like trying to solve a Rubik's Cube while riding a roller coaster, a dizzying and unpredictable experience.